Welcome back to Golden Rule Radio. We are paying people to take delivery of gold this week, so give us a call. Just kidding. We're not the oil market. We're operating in the gold and silver market. And I don't think that we're going to pay people to take possession of gold. But gold is strong. And from last week, we did see a little weakness that Miles was talking about from last week's show. And let's jump right into gold.
Yeah, Miles, I'll put you on the spot. Are you saying that this weakness that we saw here early in the week and the tail end of last week is it? Are we done? Is that your pullback, or are you going to be doom and gloom?
Thanks, Tori. Nice to know I'm building a reputation. No, I definitely don't want to say I'm doom and gloom. It's about opportunity, not opinions. Yeah, we've seen 2 consecutive lower lows, which obviously turned around, and we've had a little bump back here up to about 17.15. But if you look at the price action between, say, the middle of April, April 13th or so, through April 16th, when we put in that most recent high back on the 14th, 17.50 or so. The low end of that price action is right there at around 17.10 to 17.15. So we've come right back into a bit of a pricing ceiling today at 17.15. We just came off of 2 lower lows. So yeah, my stomach still says down a decent amount. I'd love to build that big upside down head and shoulders, because you guys know how much I like the old head and shoulders, even though they don't always play out that way, but it's always fun to see. So something like that would be nice. Another maybe $100 down in gold, just sell off a third of what it's gone up. I mean, definitely prefer to see any type of restructuring in the price going forward as we continue to climb. Every time you move back down, you're just building another base, which gives you that next launch pad up to the next price up. Now we get above 1750, there's really nothing between here and the all-time highs. So once we get up to 1900, 1950, that's when I think you start hearing television talk about things, and that's when we're actually starting to make some ground forward in gold over the next couple years. And I don't think the pending, what is likely to be a pretty severe pending recession globally, not just here in the U.S., but certainly globally, I think that is going to be positive, unfortunately positive for gold.
That's actually what I've been telling my clients, is they've been looking to maybe cost average in on something, dollar cost averaging, or adding to ounces, not that first or initial position. But anybody that is looking to add, I've said, look, we do expect a little bit of a pullback here, and use those as entry points, and yet don't let it get away from you. If we see 1750, then you really do need to go in at that point, because I'm with you. That's where the lid comes off, and really we're going to go kind of unchecked. So I appreciate you bringing that up. And the 1680-ish level that we saw it come down to didn't quite get it done, and that's okay. This is healthy market action, and there's no guarantees. We don't know. Again, every time that the Federal Reserve takes action, the federal government takes action, there's a stimulus. It may not even be domestically. It could be a different central bank. Every time that those types of stimulus events happen, that's going to push gold. And we see it today in concert with the dollar. Right, Robert? As you watch the dollar here with this strength, does it surprise you that gold's up at the same time?
No, I'm not surprised, Tori. We've had how much money created just in the last month? Not to pull up the debt clock again, but that dollar to gold ratio is now over 20,000 on the U.S. Debt Clock website. So that's moved even from last week, around 19 something. So no, not surprised gold's up. Gold's going to continue to be strong, going to continue to be the safe haven in the financial storm that we're headed into. The dollar is the relative value relative to the currencies that are making up the dollar index. So we've talked about the dollar index and gold's correlation, and not always seeing inversely correlated movements. Sometimes we see them both being a safe haven. But the dollar index is just holding just above 100. Do you think that we've peaked with the dollar index? I want to ask Miles that, being the chart guy that he is. We failed with the dollar index on this run up to 102 and change, almost 103. I think we failed to break to that new high. So is that significant that we've kind of chopped around here since failing that high to break into that new territory above 103?
Yeah, from a charting perspective, I'm not too concerned yet. I mean, we did have that 4.5% decline back at the end of March, but that was on the heels of a 9% increase and a 5% decline. And ultimately, we continue to put in higher highs and higher lows, even following that big drop at the beginning of March, end of February, beginning of March. And even here just over the last couple weeks, even following this 4.5% drop after we peaked out middle of March, coming back to about 98.3, we're putting in a higher high, a higher low, and we're coming up to test that high from April 5th. So I would actually expect to see us push a little bit higher. Now, we could see some compression going up with the dollar possibly topping out at 101.5, maybe 102, and not being able to put in a higher high. And then absolutely, I think you and I would be in agreement that we're going to start to see that weakness. With that being said, I think this leads into the deeper conversation of inflation versus deflation and what's the global demand for the dollar today. And I think demand is still pretty substantial. People are still on an international scale, not just here domestically, but in Europe, in Asia, the dollar still reigns supreme as the most liquid, most desired asset on the planet. And I think that's going to continue for a while personally. I don't know where you guys stand on that, but that's just me personally. I think the dollar remains king here despite the massive inflation that the U.S. is pumping in to cover that demand. Now, it does come to a head eventually. And the question isn't what happens, the question is when. Is it 6 months or 2 years? We don't know. But I think this fist fight between demand deflation and supply side inflation is going to continue.
I'm with you. You're right. Dollar is king in a sense, but gold is king also in times of deflation. And it's not just the dollar that's rallying, bonds are rallying too. In this type of an environment, you're going to see both. And for gold to be sitting here, when that inflation takes root and it gets legs and it's kind of the king of the hill, you're right, it might be months or a couple years away, just like what happened in 2011. It wasn't until 2011 that last 42% spike occurred to set that gold all-time price record. And yet, here we are in deflation. Normally, we have a section of this show just committed to inflation. And right now, we have to focus on the deflation because, yeah, you're getting automotive prices contracting, equities contracting, credit lines shrinking, lending slowing, and housing's going to turn down. All of those are deflationary pressures. And the fact is that gold is sitting here at $1,718 as we record. So when it goes parabolic, and silver is when it turns from deflation to inflation. But what a lot of people don't understand, and David McElvaney has given presentations on this, gold is amazing in times of massive deflation because it's pricing in what's getting ready to come as part of the fix.
And part of that fix might already be here with this huge stimulus package. I'll go ahead and say that I think they'll probably come up with another stimulus package before the end of the year. I don't think this is done. I think there's more money needed, and maybe Tori can talk a little bit of that with what's been going on in the news related to the stimulus.
It's just almost hard to keep track of because you got two primary players, just even domestically, right?
Wait, let me grab my puke bag. Hold on.
Yeah. Put yourself on mute. Yeah, let's not cause a chain reaction here, but unfortunately, you're hitting it on the head. Okay, here we just get another $500 billion stimulus bill that appears like it's going to go through the House and the president will sign it, and things are pricing that stimulus in. And you're right, Robert, that's not going to be the end of it. And you mentioned the debt clock. You're right. Everybody should go look at the debt clock because now we're at $24.5 trillion, but we know it's actually much higher. And that's essentially $200,000 per taxpayer, right? But really, it's more like $28 trillion. And that's without adjusting for the looming lost tax revenue from all the business shutdown and everything else. So right now, GDP is $21.5 trillion a year, right? So we have gone from in the year 2000, just in 20 years, our debt to GDP ratio was 58%. Now it's 113%. But watch, a year from now, it's going to be closer to 140% because that's assuming GDP stays where it is, right? And that's a $30 trillion deficit. And those are huge numbers.
Which is obviously not going to be the case.
No.
With GDP, it's not going to stay where it is because you're going to have the second quarter of this year is going to be worse numbers than the first quarter because of the lag time with the virus affecting the economy.
Yeah, and third quarter. I wouldn't rule out third quarter being even worse than the second quarter as things get to wash out.
Absolutely, because these businesses are not going to hire back the same amount of staff that they had right before the virus affected work.
Yeah, no, I mean, and each state is going to be different, right? This is going to be a slow reopening, and yet the debt doesn't go away and the interest on your debt isn't changing. And the servicing of that debt right now, from a federal debt standpoint, you're $382 billion a year just in interest, just to service that debt. Now think about that. If that doesn't scream buy gold, then I don't know what does. But problem is maybe you can't buy gold because you're part of the $20 trillion in personal debt that we have to add on top of that. And you've got to get out of debt. You got to get out of debt. You've got to acquire physical gold. Just wait patiently. Nothing has changed. Go back 40 years. We're just in a speeding up of this process here where you get these huge blips on the radar that just go parabolic and then you kind of level out for a while. But over the course of a lifetime, you just buy gold.
Well, speaking of buying gold, what do you think about buying silver?
Yeah, talk to us. The gold-silver ratio's back up to about 114. It's got a better value than it did last week. Show us that chart.
Yeah, and that brings up the ratio, but it also brings up the ability to perform with that ratio given the premiums that exist in all the deliverable silver items. If some of you listening have seen the shortages going on in our industry, it's created high premiums for anything deliverable with silver. So we do have some options that might be attractive to be able to do the exchange efficiently. So invite you to give us a call if that's of interest to you.
Yeah, that's a really key point. And Robert, we hear about shortages and we really aren't having much of an issue. You're seeing some premiums climb, but there's nobody that we've had to turn away. We don't have a minimum. We don't have a maximum investment level, right? You can call and just get a couple silver eagles. And yes, we can still get silver eagles. But in terms of that ratio play, there are ways to maximize the strategy by avoiding some of those premiums and buying yourself an extra 10 to 20%.
Right. So what we're specifically talking about there is premiums on silver eagles. I don't think you can even get maple leaves. Rounds are not available. Junk silver has a high premium. So even 100-ounce bars have a high premium over the spot price. So if you're trying to do the conversion from gold to silver efficiently, it's very difficult to do out there in the retail market. I think we work for McIlvaney, who's been doing this maybe longer than almost anybody here in the country. We've been through this type of thing in our industry before where our company has been there and seen this type of thing. So luckily, McIlvaney prepared for this type of environment, and we do have product. So if you are interested in talking with us about how to do things efficiently with the ratio or prices of products, things like that, then I invite you to give us a call.
Yeah, and I would only correct you on one thing, Robert, and that is that we can do silver rounds. Those have opened up.
That's right.
Another real cost-effective way to go about the silver angle.
Yeah, well, looking at silver specifically, or at least how the prices moved over the last couple of days, silver came up. We got above our 50% line that we talked about last week. We came right into the 50-day moving average or just below it, and of course, we've turned back down. But silver is stair-stepping up even in the short term here. I wouldn't be surprised to see silver at least go up another $1, test around $16.50. That's kind of the floor of the late 2019, early 2020 move, right around $15.50 you can see on the chart here. And then we'll see how it responds from there. But as I've been talking about for a while now, silver still remains long-term bearish, and we need to see some bigger, higher highs, so to speak, not just these inter-day or inter-week movements. So that's why I remain pretty interested in silver going forward. It's not just because it's bearish. I don't like to buy something when it's on its way down. I'd rather wait till it's on the way up. But in this case, I think with gold up now $600 off the lows back in 2015, with gold leading the charge just like it did prior to the 2008 market crash. I think I said this 3 months ago. It's 2006 again. Gold's leading the charge. Silver and platinum still need to play catch up. And I think that when they do, when the general public realizes that gold is no longer affordable to the average person, they're going to turn their sights towards silver. And that's why we saw silver go from $7 to $50 in 9 months back in 2010.
Well, I'm interested with silver to find out what the price does when the world gets back to work. We're on the verge here, at least in Colorado, of having the stay-at-home mandate at least lifted in the first phase. And I'm really interested to see that when the world gets back on pace of trying to recover from this shutdown globally because of the virus, Does silver jump up because the demand from the industrial world starts to pick back up? Because that's what a lot of the demand for silver is industrial, right? So it's lagged and been hit. It's lagged gold and been hit in price because of the virus. So what happens when the virus situation unleashes people getting back into the industrial side of production? I think it might actually, you might see silver turn bullish. I'll just say that that's a very high likelihood. I don't want to say that it is bullish because it's obviously not with the chart, but I think it could really quickly change when the world gets back to work.
Well, and that sort of reminds me of oil and what we've seen happen here lately. You know, it gets completely wiped out. Contracts become worthless. And you've really got to listen to the McIlvaney Weekly Commentary this week because, yes, you will see prices change, Robert, when everybody gets back to work and industry picks back up. Who knows what oil will do, how long it will take it to rebound. But one of the things is the strong takeaway is you don't own contracts. You own the real stuff. And the same thing goes for your gold and your silver. You know, did oil become completely worthless? No, a contract did, right? But if you owned the barrel of oil, it still had intrinsic value and you just sit on it. Same thing with your gold. You know, I guess arguably you could say a gold contract could become worthless. That doesn't mean your coins and bars ever will. So be careful there and just keep your eyes on the horizon. A lot of this is long-term. We're not talking about short-term trading. The central banks in the group of 7 countries have purchased $1.4 trillion of financial assets in March. That's going to continue. We haven't even seen what happened so far in April, but that is 5 times as much as the previous monthly record set in April of 2009 after the last crisis. This is a much grander scale. You better get ready for price actions that you've never seen before. And I'm not just talking about gold and silver. All of it's going to happen. So be ready for defaults, be ready for muni defaults, state defaults, personal defaults. All of that's coming down the pike. And again, that's why you own gold.
So that's going to do it for Golden Rule Radio this week. We appreciate you joining us. If you liked what you heard, click the subscribe button, ring the bell, head on over to our website, McIlvaney.com. You can find us on Twitter at ICA Gold or Facebook, McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of our advisors here at McIlvaney Financial Group, you can call us at 1-800-525-9556.
Thanks for listening. Have a great week. Thanks for listening. Have a great week.